Hello and welcome to Pro Trader Strategies for Friday, May the 15th. I'm Eric Wilkinson, and yes, you very well may recognize me from mainstream media where I've talked about the economic data, how that impacts the overall markets. Well, I do the same thing in these daily market commentaries. I talk about the economic data, the geopolitical environments, and how the overall markets are going to perform. I also layer on top of it then some option strategies that I find to implement around those assumptions we come up with through all that. Also, I'm here to teach you guys how to implement options into your own portfolios in your own way. So what we do is we talk about the different aspects of each option strategy, the nuances in and around that, and then based on our assumption, we find the right strategy for that assumption to increase our probabilities of success. That's really the only way to increase your overall yield in your portfolio is through options. All right, so without further ado, let's get on with that economic data. And it wasn't so rosy today, to be quite honest. We got core retail sales coming in at negative 17.2%. Expected to be pretty bad, right? But it was only expected to be a negative 8.2%. Now, retail sales, the core retail sales is going to, by the way, exclude autos, all right? So nobody's buying automobiles. But then we also got, well, why would you be buying an automobile? Well, one of the surprising things about that is people are going to maybe start pulling back from rideshare has been some of the conventional wisdom and buying their own cars again and starting to use that because they don't want that ride sharing thing going on or going in taxis and stuff like that. Well, clearly not the case, but it could basically be because a lot of people have been laid off and there's no need for a car for that matter anyway. So retail sales also with the, retail sales with the autos is negative 16.4%, expected to be a negative 12. So retail sales with the cars. Sorry, the core retail sales. Sorry, we got dogs going crazy. Core retail sales, stripping out the autos, was really bad, and that is having to do with people aren't going to the malls. The malls are pretty much closed, right? I mean, most of the retail stores were closed. One thing to note, though, the e-commerce retail sales was going through the roof. I think it was up over 20%. So that's where the sales are going. So this number is a little bit misleading on the core retail sales being that dismal. A lot of those type of purchases were being done online. So not as bad as we would have expected. We got Empire State Manufacturing coming in at negative 48.5. Again, pretty bad, but it was expected to be a negative 65 and better than last month's number, which was negative 78. So there is some silver lining if you're looking for something there. And then we got capacity utilization coming in line with expectations at 64.9. Industrial production came in at negative 11.2, which was in line with expectations. The factory, the capacity utilization and the industrial production numbers, those factory industrial production numbers was a what was I saying? I don't know. I can't even read my writing on that note, but basically it was a pretty massive downturn there. Anyway, and a lot of this weakness we're seeing here, trying to get back on thought here, is basically due to Powell speaking. You know, we talked about Fed governors talking all this week, and well, Powell didn't really help anything by saying we're having an unprecedented economic downturn, and you know, we already know that. You don't really have to, I don't think, beat that dead horse there. Anyway, let's talk about markets. We've got crude oil moving higher by about $1. I talked about this yesterday, that if we got above $26 a barrel, that line in the sand there that was acting as resistance, that we could see a pop back into the 30 handle. Well, you can see yesterday we got above that 30 handle, and it was like the shorts were on their heels a bit and rallied right into the close. Now today a bit more follow through, up another $1, so it looks like that 30 handle is almost a sure thing going forward. And we're going to be keeping an eye on this gap to be covered here. All right, so a lot of this is having to do with A lot of these economies are starting to open up. I mean, I've been seeing pictures of people at bars that are jam-packed. I mean, people are going out in full force to because they've had such cabin fever, they can't wait to get out. So they are driving, and we're seeing some factories start to open up. So that's going to be driving some demand here too. All right, we've got gold futures up about 16 points right now on the day. I am actually, remember, I've got that GLD Iron Condor on. I'm keeping an eye on that one. It is very close to 30% of max profit, which is one of my rules. 30 to 50% of max profit is where we take those off. Well, I'm right there at 30% right now. I'm squeezing it out a little bit, working for about a 40% of max profit trade there. I sold that Condor for $1.37, and I'm working a 90-cent bid. So maybe a little bit better than 40% there. I just doing the math in my head, it's pretty close anyway. So working that order today, I think it's trading around $1, so not quite that close. I'd need a bit more of a pullback maybe to get that off. Anyway, so that's just a working order. I'm not going to dwell on that too much. We've got bonds coming off by about 19 points or 19 ticks on the day, just slightly over a half of a percentage point there. I don't have the VIX up here, but we do have the Dow Jones off by about 100 points. That actually is a little bit better than what we've been seeing here. I don't even know where my VIX is right there. Let's just take a look at the VIX. It's coming up a little bit after yesterday's fall off. Yesterday, into the close, we just rallied almost unabated from the time I did this daily market commentary to the end of the day, and it started making those charts set up really nice, like I was talking about, making them look like those dojis were going to create a bottom there. Well, we're going to have to wait to the end of the day to see if this is a confirmation of a little bit of a bottom here. As of right now, not really being able to read the tea leaves that well, but a close near the highs that we've already seen today, right near that 9-day moving average here in the Dow Jones, as you can see. A move to that would be a positive sign, would make it look like a positive move there. So that would be something we would want to see, and that 9-day moving average is something that would be a key level to try and get above if you are really wanting to see a bullish sign there. Something above this 9-day simple moving average right there, that little blue line. We came up, tagged that, and started falling off a little bit. We were in positive territory, albeit for a very short period of time, but we've been seeing some wild swings here with the markets, especially right after the economic data came out. Here we have the NASDAQ. Let me move this down for you so you can kind of see. We've got the NASDAQ down about 67 points, but again, you can see we were in positive territory, and we've got that 9-day simple moving average we got to keep an eye on. We did settle above that yesterday again, which we have been settling above for quite some time. A settlement below that means there's short-term weakness coming into the market, so we definitely want to see that push to the upside. I'm not too confident we're going to get that though, folks, because remember, if we go back and look at almost every single Friday or every close headed into a weekend, we're seeing the equities really fall off again. Why? Because there's uncertainty going on into the weekend, right? Nobody really, with the traders don't really want to hold anything over the weekend because there are some unforeseen spikes maybe in COVID, right? Especially if we're starting to see the economy start to open up here. Well, over the weekend, we could start seeing maybe some more spikes in these COVID cases. So the transfer rates start to happen a little bit, maybe that curve not getting flattened out. So that is just, not that I'm saying that that's what's going to happen. I'm just saying those are what the thought process is here with the traders and why they don't want to hold trades going into that weekend. So we're probably going to see weakness throughout the day is all I'm saying here. So I'm not too confident we're going to get a nice big rally at the end of the day to close at the highs. All right, E-mini S&Ps, as we can see, off by about 13 ticks. NASDAQ is the one that's the weakest, to be quite honest, but that's been doing the best, right, to the upside. So a lot of people wanting to take some profit on some of those different things, like Microsoft, for instance. I have on Microsoft too, and that's done very well. You know, a lot of people are wanting to cover those kind of trades. I have covered calls on it, so I'm pretty confident with it. But we've been seeing Microsoft lose a little bit of steam as of lately. Well, we can see here, E-mini S&Ps pretty much on the open. We were trying to make a bit of a rally, but that's where we started seeing that economic data come out and was throwing a wet blanket on the overall markets. So we saw some weakness there through every time we got the economic data. That's where we've seen some of that pullback. Maybe seeing a little bit of a rally here, but like I said, it's been pretty choppy in here. Pretty big swings going on throughout the day, it feels like. And I'm not extremely confident that we're going to finish near the highs. That would be a great thing, though, for my position and probably yours, as I am overall delta long in the most markets. All right, EA Sports starting to make a big move here. Remember, I did this on the ratio call spread, where we basically have a long call spread, kind of wrapping it around our long stock, because I am long EA or Electronic Arts. I don't know why I always call it EA Sports, but you know, it's in the game. But Electronic Arts has had a nice move. I am long that stock in my portfolio, and I was talking about this when I was doing this ratio call spread. It's like when you have that stock, you're not really completely sure about the upside. You don't want to throw more capital at it at the highs or near the highs, right? Well, why not do this ratio call spread? Because you collect a credit for it. So if you are wrong, well, you've lowered your overall cost basis on that stock you own, right? And if the market makes a nice move higher, which I have this set up for that 120 handle, which is the 52-week high, that actually was created after I put this trade on, but it was one of those lines in the sand that I was looking for. If it goes up to 120, that's where I'm willing to get out of some of my stock, and I want to take advantage of it goes there. Now, I don't want to put a bunch of capital into this type of trade, so creating this ratio call spread was the right choice for that type of situation. And we're talking about this in these webinars, so make sure you're talking about or watching these implementing options into your portfolio, you guys, because it seems like that every single time I've done one of these for the implementation of options into your portfolio has lined up almost perfectly with the overall environment we're seeing and the perfect scenarios for things that we have been trading. So Electronic Arts was one of those where I was looking at, I want some upside, but I'm a little bit worried about it. And if it gets up to this level, then I'd be happy to pair off some of my stock at, like, you know, these massive highs. So especially when we're looking at this economy. So that those were the thought processes I had going on with some of my Electronic Arts trade, and it's working out quite nicely today. All right, so actually, as of recently, ever since I put that trade on, which I don't have the exact date off the top of my head right now. All right, IWM is making a bit of a move here, where we can see that the ETF for the Russell 2000 is up about $1.29 right now, right at that 124 handle. Now, yesterday I was doing a trade on the broken wing call butterfly. And basically it's a call butterfly, but we are embedding a synthetic short call spread in there to allow us to get rid of any downside risk in this trade. All right, so I talk about the right strike locations, how to set all of that up, the right environment in the webinar, so check that out. I don't have the time to dig through all of that stuff. I mean, the webinars are an hour, so I can't do that in a 10-15 minute video here. But anyway, we talked about this trade here, IWM. I'm a little bit worried about the downside in this, but I think there's a little bit more upside potential. I don't think we're going to go blasting off higher, especially with the Russell 2000, because it's got a nice mix of different underlyings in there, where we got healthcare in there. The healthcare could do very well, but then we got the financials in there, which are probably going to struggle a little bit. Some other basic consumer staples in there. So it's got a nice big mix of different underlyings in there. Well, you can see, as we see with Russell generally, that it has a tendency to kind of trade sideways, maybe a little bit down. And when it goes up, it doesn't go up skyrocketing. Now, of course, we do have this right here, but that was coronavirus and everything fell apart there. So I am expecting this to kind of trickle a little bit higher. So I've kind of tried to nail the number with this, where I think this market is going to go to, and it's probably very close to around that 130 handle, and I think that we'll kind of pinch down and start building up in and around here. That's just my thought process going forward. So I decided to build this strategy out for the June, which is 35 days to expiration, and we bought the I bought the 124 calls and then sold 2 of the 129 calls for every one of the 139 calls that I bought. So you can see it's a broken wing. Normally a regular call butterfly would have been the 124, 129, 134, right? So buying those 134 calls, that's the regular call butterfly, right? Well, when I was talking about that embedded short calls, those 134 calls, you get out of them. You sell the 134 calls and then buy the 139 calls. That's that embedded call spread. So I scratch out of those 134 calls, all right? So that's what I was kind of mentioning there, and that's what creates that broken wing butterfly. I've added risk to the upside, but by doing that embedded short call spread, synthetic embedded short call spread, I've eliminated all my risk to the downside. So in this trade, anything basically below where we are right now, 124, I've gotten rid of the risk. So right now we're at 124, let's call it 124 if I put it on there. So my risk to the downside, if the market goes down the chart line, it's kind of like this. All right, so I've added risk to this side. This is normally where those 134 strike is to the upside. And then further up the timeline is my 139 strike right there, which is where my max is. And then at the top of this move is going to be right there at the, what did I say, 129 call, 129s. All right, so those are where my 129 calls are. So currently trading right here, and then to the downside there's no risk. So if the market goes down after this, or going into the weekend, a good trade, right, we could see some things happening. I've added some downside possibility to my thing, and I've done that all for a credit of 38 cents. So I collected 38 cents for that trade, all right, or $38. So if it goes down, heading down, then I'm going to get to keep that 38 cents. If we go up and start pinning at that 129 strike, then that's where my max profit potential is. Anything above that, I start to see my max profit or my profit start to dwindle a little bit. But my max loss is when it trades above 139. All right, so that's it. I added that. We talked about this trade in detail, as I almost kind of did here, but you get a little bit more color in those webinars. So check those out. Go to protraderstrategies.com. As a matter of fact, I think you can find it on Facebook. I think I saw that that was put out on Facebook this morning, so you might be able to check it out there as well. So follow us on Facebook at protraderstrategies.com to get that that video as well. All right, we've got this disclaimer as always to go over. Keep in mind, we are an educational company. I am not trying to get you guys to implement this strategy into your portfolio around IWM. That's not what we're doing here. What I'm trying to do is, when I have an assumption where I don't think there's a whole lot more upside potential here, I'm neutral to slightly bullish, if you will, but I am so worried about the downside, or I at least have this thought, well, hey, the downside is something that is very real here, and I want to eliminate that risk. I think the upside is kind of a little bit long in the tooth. So that's kind of what my thought process was this. And you could have that around XYZ. Yes, I think there's maybe a little bit more upside here. Want to take advantage of that if we get that little upside. Do I think that this market is just going to skyrocket? No. Therefore, we're starting to think this through. But what about that downside? Heading into a weekend, we're starting to see the economy open up. We might get another sell-off here. Well, then we look at the broken wing called butterfly for a situation like that. All right, so and then we look at the environment and everything else around that and how we build that out. That's what I do in those webinars. Check it out. But please go over this disclaimer really quick and make sure you understand there is inherent risks in trading. All right, that's all I got for you guys. I hope everybody has a great weekend. And if you can't take that, take it easy.